Somehow in the UK, someone needs to accept that they're worse off.
That was Hugh Pill on an American podcast, stating in as many words that the UK population need to accept that it is poorer. An awful way of phrasing whatever it was he was trying to say. And the worst thing is, it makes the public disengage with the Bank of England because they just think that they're out of touch. But the actions of the bank have massive impacts on our lives, and that's why today I want to go through the latest monetary policy report to see how the bank is trying to tackle some of the biggest issues in our lives at the moment. I've linked the full report and the accompanying recording of the meeting below for you if you're interested, but let's just start with inflation.
An inflatable globe.
Inflation is currently at 10.1%, 0.8% higher than they expected in the report from the start of the year. When we're being told to swallow the bitter Hugh pill of declining wealth, I think it's perfectly reasonable to flip this and say, why is inflation in the UK worse than you thought it would be? And more importantly, why is it higher than most other countries in the world?
Globe.
The UK has the third highest inflation out of all these major economic areas. Now, Europe is a big region and some places in Europe have much higher inflation than us, and this figure here is just an average, but still, only Argentina and Turkey have it worse. The Bank of England was genuinely surprised by the recent inflation figures and have said that sharp increases in prices of food and clothes are to blame. This shock annoys me, honestly, because anyone anywhere at any point in the last 12 months could have told you that food prices are going crazy and they're not really slowing down. But the Bank of England are quick to point out this isn't just a UK problem.
This is not just happening here in the UK.
This chart shows us how food prices have also, risen in Europe. They expect this food-based inflation to come down quickly. They don't think it's here to stay. But that isn't going to provide any form of short-term relief on the cost of your food shop. It's highly unlikely that companies who have increased prices will then drop them again. I can't see the price of a tin of beans coming down anytime soon. But the rate of growth needs to slow down. Food inflation was around 19% last year. So when will inflation finally fall? According to the Bank of England,
And we have good reasons to expect headline inflation to fall sharply from April.
it always seems like they're promising that inflation will fall just around the corner, doesn't it? But to be fair to the bank, they've been consistently saying for 6 months that Q2 2023 is when inflation will start dropping sharply. Even if the amount has changed, the timing of the drop has not. But as I sit here in 2023, we're right smack bang in the middle of Q2. So that means inflation should be falling right now. The April numbers come out in a couple of weeks, so we'll know then. But here is the bank's forecast. They anticipate inflation will fall sharply all the way down to their target of 2% by late 2024. Sounds ballsy to make those claims considering we're sat at 10.1% now on the most recent figures. But there are some reasons why the Bank of England can be confident that inflation figures are going to start falling. First of all, energy.
Electricity was tamed and put to use.
There's been a large drop in the price of wholesale energy, and that's feeding through to prices, albeit very slowly. This graph shows they're forecasting a drop in the average energy bill to £2,100 by the end of the year, a 16% decline over a year before, but still double the level from the recent past. But as energy makes up 5% of CPI data, that translates to a full 1% drop in the average price growth. You can see here that energy in orange has made up a huge part of the inflation mix, and it's starting to decline as prices decrease and then that feeds into the system. This will reduce the rate of inflation, but I do think it's also worth pointing out that both America and the EU have seen massive reductions in the impact of energy prices on inflation, a nod to our need as a country to seek energy independence as soon as possible to reduce our dependency on imports. Okay, the second reason why the Bank of England can be so confident inflation will start falling in the coming months is down to how it's calculated. So we measure inflation over a 12-month period. So when they say 10% inflation, that means prices have risen 10% since this time last year. But remember, inflation is compounding. So if in year one bread cost me £1, the price inflates by 10%, it now costs £1.10p. Then the year after, inflation is only 5%, meaning the rate of inflation has fallen. The Bank of England gets to go, look, it's coming down, but that's still a 5% increase on that £1.10p. So the new price is £1.16p. This means inflation is susceptible to something called the base effect. This is a term used in statistics where a first year's result affects all the other results. So if something shoots up in price by 50% in 1 year, going from £1 to £1.50, that's 50% inflation. But if the next year it goes up by 15p, then that's only 10% inflation in comparison. So the rate of inflation has fallen even though prices have risen, and even though that 15p rise would have been 15% on the base figure the year before.
I have no idea what you just said.
But hold on a second. Clever accounting does not mean that we're out of the woods yet. There are some worrying signs around inflation that means that we might not just see it disappear rapidly, as they hope. In the discussion that accompanies the report, Andrew Bailey is very clear to separate core inflation and headline inflation.
So we also have to look carefully at other components of the consumer price index, so-called core inflation.
So headline inflation is everything. Core inflation is inflation after you take out energy and food prices, which can be highly volatile as we've seen recently with food. Communication, education, recreation, all these things make up core inflation. Sounds like a bar from a Kendrick line. But looking at the report, I am struggling to find rhyme or reason in Andrew Bailey's discussion around this. Let me just play you a clip from the meeting that accompanies the document.
So while CPI inflation is expected to fall quite sharply as energy costs begin to ease, albeit at a somewhat slower pace than projected in February given the near-term outlook for food prices, the outlook for inflation further out is more uncertain.
Translation, energy prices and food will come down, but we're unsure if core inflation, the persistent kind that really is a worry, will go down quickly. I spoke about the threat of core inflation, especially in the services industry, and the threat it poses to us in the last time I covered the report. It's concerning that the prices of services, the thing that this country does the most, are still going up. This core inflation is much harder to tackle if it embeds itself, and Andrew's comments really reflect the uncertainty here and how this is going to pan out. But I just want to remind you that one of the headlines of this report is, we expect inflation to fall quickly this year and then meet our 2% target by 2024. There's a mismatch here between messages. We expect inflation to fall quickly versus we're unsure if core inflation is persistent. The word uncertain features 25 times in the report, and I think it really sets the tone of the message here that while they might be confident inflation will start falling, where we land and when is very much up in the air, demonstrated by this fan chart that shows the broad range in their expectations of how inflation will pan out. This deep orange line here is their best guess, but we can see that their worst case scenario is that in 2026, we're still near 6% a year inflation, which would honestly just be a disaster. So what are the Bank of England doing about it? Well, I guess you kind of already know that, I'm sure. Interest rates. I think Hugh Pill's horrible message of accept your poorer was the misplaced words of a frustrated man who is seeing resistance in inflation figures to the central bank's plan to limit inflation. I mean, they've put up rates 12 times now and inflation's barely moved. So what's going on? I think sometimes when we hear they're putting up interest rates to tackle inflation, we can often get lost in that sentence and what that actually means. What they're actually doing is putting up interest rates to try and stop you from spending. They basically want to reduce consumer confidence, aka our confidence in our own ability to spend. They make debt and borrowing more expensive, we stop buying stuff, demand reduces and prices come down. Well, they won't come down, but inflation, the prices rising, should slow down. Or at least that's the plan. It hasn't really worked yet. 12 rate rises and inflation is still very much here. So faced with this, what did the Bank of England do? They slapped up the rates again. Now they sit at 4.5%, up 0.25% or 25 basis points, as they call it. And the market is predicting they'll probably raise the rates one more time, ending at 4.75% by the end of the year. So I guess the question we need to ask is, if rates have been jacked up 12 times already and nothing's happened, why do they keep putting them up, punishing us financially? To explain this, I want to share the data they've given in the report about mortgage costs. If you want to read more on this, it's called the cash flow channel of monetary policy in the report, this whole section here. So as the bank cranks interest rates, mortgages become more expensive. We've seen that with the raising rates on new mortgages, but the bank states here, many mortgages have yet to experience higher rates. Although the rates being quoted on new mortgages have risen by around 3%, the average effective rate on existing mortgages have only risen 0.7%. That much smaller rise reflects the fact that fixed-rate mortgages account for 85% of all mortgages. This chart puts that paragraph into visual form nicely. We can see here in the light blue
That's green.
how the rates on 2-year 75% loan-to-value mortgages have shot up and how that has also been reflected in the rates people are paying on new mortgages in orange. But the purple line shows how the average rate on the entire stock of mortgages, including this 85% of people on fixed rates, has not shot up, as the fixed rate deals are protecting people from the impact of those rate rises. This chart shows how the bank expects over time this impact to feed through into the market. Now, the bank is unsure how much impact there already has been, and they acknowledge that many households may have already cut back spending in anticipation of expensive mortgages, but the fact stands that 1 million households a year will be remortgaging at higher rates. For my American viewers, first of all, thank you for watching a video on UK economy. And secondly, we don't have 30-year fixes like you do here. They're not very common. They're typically 2 to 5 years. Your 30-year fixed rate mortgages are truly a wonderful thing. The Bank of England state in the small print here that for every £1 a mortgage goes up, a household reduces their expenditure by 40p. While unpleasant, it's this reduction in spending that they think will lead to a fall in the inflation figures. Some will say that the Bank of England should not raise the rates anymore then, and instead hold them at the current level, allowing the current rates to feed into the market. 2 members of the Monetary Policy Committee voted against further rate hikes, and probably for this reason. If we look at a forecast for the rates and how they're expected to pan out, we can see them holding the rates up here for a while. It's more the holding of the rates at these levels, meaning more people remortgage at higher levels, that has the impact, not the sharp rise we have seen in recent months. All pretty bleak when you think about it, isn't it? That they plan to make us poorer so that we stop spending. So let's look at some positive news now. They think the UK will avoid a recession. Better than that, they think the UK will grow. I mean, we're not talking explosive double-digit growth as a country or anything like that. More like stagnant, flatline, slight signs of life sort of growth. Here's that on a trusty fan chart. We essentially hovered just above zero in 2023 in their best guesses, and they say that this revision in expectations is due to lower energy prices and the stimulus from Jeremy Hunt in the last budget. I do want to say, though, that this growth versus our international peers is very poor, but the outlook has improved all the same. And that's good because a growing economy means ultimately that less people are likely to lose their jobs. And we also see that in the unemployment forecasts. The bank thinks unemployment will stay below 4%. Now, I know people criticise this data because it can be heavily manipulated, but the overall tone is less people will lose their jobs. That can only be a good thing. But I also, again, just want to point out, look at the range again here. This reflects the bank's uncertainty in their own forecasts. Look, the overall theme of this report is very much one of uncertainty, which isn't very reassuring coming from a central bank, is it? After reading this, I'm unconvinced that they know where inflation is going short to medium term, and that any reduction in the headline rate is more accounting and external factors than it is down to the actions of the bank at this stage. But we'll look to the figures in April, and if they're falling from 10.1% by a good chunk, then I think we can say that we might have turned a corner and be heading in the right direction. Not that it'll feel like that from a household budget perspective, of course, as lower inflation still means higher prices. But there are some positives here. The UK economy remains resilient considering everything that's been thrown at it. And if we can avoid a technical recession and all the panic headlines that come with that, I think it'll be a modern day miracle, surely. Right, now I'm off to go stare in a mirror and tell myself I'm poorer. Thanks everyone, and thank you, Hugh.